Hey everyone, give me a second. Let me just set up real quick and we can get started. Hey there, Lincoln here from bullacademy.org. Today I want to take some time and listen to the SoFi IPOE investor presentation webcast or their their presentation where they discuss what the opportunity is for IPOE, the SPAC that's taken social finance public. So SoFi, as you all may know, I am very bullish on SoFi. So I want to just continue to share with you all why I'm so bullish and give you an idea of what the people who are putting the deal together think about the company's past and its future and what makes it special among the other fintech companies such as Chime and such as Robinhood, and there's so many fintech plays that you can go into. But I personally think that SoFi is stands alone in the space because of all the different business units that they have and all the different opportunities and how they're putting it all together in a vertically integrated manner and centralizing so many services that make it easy for consumers to build their wealth over the long term and keep it all straight, right? So you can get personal loans and you can bank with them, you can get home loans and so many other great things. So we're going to just listen. It's about a 50-minute webcast, but it's very informative. And I want you all to just let me know in the comments and live chats, and let me know what your thoughts are. And if you have anything that you want me to cover and break down more as you listen, we can stop and I will give my analysis, of course, as we go. But first up will be Chamath Palihapitiya, the guy who is behind IPOE and his social capital team. And he's going to give us the full story, right? He's going to tell us the story of what makes social finance, SoFi, special and why this is such a great deal for all of us, right? Retail investors, for investors in the pipe and in the private investors, and what the margin of safety is, right? How we're going to go from where we are today to even further growth in the future. So there is margin of safety. There is a lot of upside in this company, and that's why I'm investing. That's why it's my biggest position. So without further ado, before we get into this video, if you enjoy it, like it below, subscribe to the channel, hit the notification bell, comment your thoughts, and let me know what you all think about this company. Yes, we are live, Anon. So yes, please comment. And I just turned on live. Excuse me. I just turned on super chat. So if you want to try that out, give it a shot. But anyway, if you want to support the channel financially, join us over at patreon.bullacademy.org. That's where we discuss the stock market in real time every day and discuss the SPACs and stocks that we're all invested in to give each other more opportunities to get in early on new deals such as IPOE and CCIV Lucid Motors, where we got in at $12 per share before we went up to 65, and SBE, ChargePoint, all these other deals that we all share our ideas on, and of course debate and have meaningful discussions on. So I would love to see you over there. There's about 100 of us now, so Of course, if you're interested in that, join us over at patreon.boacademy.org. And without any more, let's just jump into this webcast. Thank you, Alan, for your very nice comments. I will get to live comments soon, but let's jump in and we can listen to what Chamath has to say here. And if you excuse me, I have to go get my water. So I'll let you guys listen to the first minute, which is of the legal disclaimers and all of that, and then Chamath's gonna come in after a minute. So let's jump in and we'll listen to Chamath and then the CEO of Social Finance.
To the SoFi and Social Capital Head of Sophia Holdings Corporate 5, or IPOE, Investor Conference Call and Webcast. IPOE has filed an investor presentation with the SEC, which is also available at sofi.com/blog/investors. Please review the disclaimers included in the investor presentation and refer to that as a guide for today's call. The presentation will also be helpful to reference in conjunction with management's commentary. Management will not be fielding any questions on today's call. Statements we make during this call that are not statements of historical facts constitute forward-looking statements that are subject to risks, uncertainties, and other factors that could cause our actual results to differ from historical results and or from our forecasts, including those set forth in IPOE's Form 8K filed today. For more information, please refer to the risks, uncertainties, and other factors discussed in the SEC filings. All cautionary statements that we make during this call are applicable to any forward-looking statements we make whenever they appear. You should carefully consider the risks and uncertainties and other factors discussed in IPOE's SEC filings. Do not place undue reliance on forward-looking statements, which we assume no responsibility for updating. With that, I'll turn the call over to Chamath Palihapitiya, founder and CEO of Social Capital.
I know that was very slow, but we're going to get into the story now of Chamath Palihapitiya. It's a very captivating story of what makes SoFi so special. So hang in there. I know that was slow, but we'll get to more excitement soon. Let's jump in.
Hi, everybody. Thanks again for joining to learn about this combination between IPOE and SoFi. Before we talk about the company specifically, I wanted to take a step back and talk about something that's really important in the grand sort of scheme of innovation and what's happening in technology markets. If you look under the hood on some of the most incredible businesses that have been built over the last 20 years, it would surprise you to learn that there actually is a very common playbook that has been repeated over and over by the best companies and the best CEOs. And what's interesting is that irrespective of whether those companies existed in fragmented markets or in highly regulated markets, the outcome is starting to look very much the same, which is that when you are lucky enough to capture lightning in a bottle and have an initial hero product, these very special CEOs and companies find a way of building on top of that momentum. And what they do is they use technology to drive down the cost of delivering that killer product, and then they pass on those savings to consumers. And in doing so, what happens is consumers not only adopt that product at scale, but it also gives the company permission to innovate and build many more products on top of the same common infrastructure. And when you do that, you really win consumer trust. And what that really means is a feeling by consumers that you, the company, are democratizing a key resource that they really need. And when you do this successfully, what's incredible is that there have been some amazingly large winner-take-most outcomes that have developed. For example, if you look in the mobile sector, and what Apple has done over the last 20 years is exactly this playbook, starting with the iPod. Similarly, in autos, we believe that Tesla is in the midst of driving this winner-take-most outcome there as well, as we move to a clean energy battery revolution. And most interestingly for today is looking under the hood of what's happened in e-commerce and studying closely what Amazon has done. Because what they have shown is not just that playbook, but doing it in two very complementary markets, building a best-in-class consumer business and marrying it to a best-in-class enterprise business. And by doing so, what they have really done is create an incredibly large moat with very predictable, long-term, double-digit compounding. And that's the playbook that we wanted to see could be built in financial services. What's interesting about financial services is that since 2010, coming out of the great financial crisis, we have seen what can probably be described as a stagnation in the product. These large financial institutions, through a combination of very strict regulation as well as extremely old legacy technology, has been very much handcuffed. And in so doing, consumer dissatisfaction has continued to go up. NPS has continued to go down and in some cases have gone negative. And in many ways, what's happened is that these companies have stopped giving consumers the value.
NPS is Net Promoter Score. Is pretty much a measure of how happy customers are with your product, and you want higher NPS. And he's saying here that all these other financial services and banks are driving down their Net Promoter Scores because they're acting in ways that customers do not like. And SoFi is changing that, right? So let's keep listening.
To understand that disruption, what we can look at are things like neobanks. So over the last decade, for example, there have been more than 295 different neobanks put in business by venture and private equity investors. This disruption of core checking and savings accounts is really the first canary in the coal mine about the impending disruption that's coming to financial services and banking. Because beyond just that core capability, what we see when we look across the landscape now is more than $500 billion that has gone into creating hundreds and in some cases thousands of small startup competitors that are systematically dismantling the existing value props of the incumbent financial organizations. The problem that this innovation creates, though, is now twofold. If you're a consumer, where do you start? What do you do? How would you figure out that there's a company amongst all of these choices that can actually be a one-stop shop for you, that can help you organize your financial life in a way that gives you a sense of safety and security for the future? And similarly, if you're an investor, how would you allocate capital into such a fragmented ecosystem? How would you figure out whether there could be, like in these other categories we've talked about, a potential winner-take-most outcome? And so what we did was we wanted to try to answer these questions. And so we went back to our playbook. And we looked at the tens and hundreds of companies that we've interacted with in the financial services space, and we started to rank them and rate them and measure them across these dimensions. Could we find an exceptional team that really understood how to build on top of an initial product, to continue to build customer loyalty and trust, to use technology to propagate that to many millions of consumers, to drive mass market adoption across multiple products on the same common infrastructure, and to democratize, in this case, access to money? What we also wanted to do was understand across all of the management teams that we met, who really understood what consumers truly wanted. And from our perspective, consumers want in fintech what they want in most other categories. Number one, they want low to no fees. Number two is they want transparency. And in this case, what that means is fair and transparent lending. And then number three is they want integration. They want the ability when they start a relationship with a company, for that company to provide a whole set of integrated products and services so that with one relationship, they can accomplish many tasks. The second thing that we look for is a team that really understood how to build best-in-class consumer apps and websites. The reality is that we have now moved into a fundamentally digitally native world, and it's important that a team realizes that the experience begins and ends on the internet first. The third thing we looked at is trying to understand where these businesses focused in terms of their initial customers. In financial services, it's been well proven that it's very difficult to start with subprime customers and move up the credit worthiness curve. In fact, it's much more likely that if you start with high credit-worthy customers, build a great lending practice with low losses and high predictability, you can then offer that product suite to every single person. And so finding initial customers with high LTV was really important. And then the last thing, if we really wanted to see a winner-take-most outcome, was trying to evaluate who was built on a modern technology stack, such that, very similar to Amazon, a company in fintech could use the consumer business as a Trojan horse to also build a best-in-class enterprise business. In this case, what we would call an AWS of fintech. Because if you put all of these things together, what we thought we would find is a business that would have had really enduring relationships across multiple products. You would see that through really low cost of acquisition and really high LTVs. But what you would really find is an extremely sticky platform, a trusted partner for every single major financial transaction, not just for consumers, but also for enterprises. And you would see that manifest in very, very low best-in-class churn. And across all these dimensions, what I can tell you is that SoFi ranks the best. And this is why we're so excited to partner with them on IPOE. The setup for this company is really incredible. SoFi is systematically dismantling more than $2 trillion of market cap that is held by all the companies on the right-hand part of this slide. In fact, many of these companies are forced to fight with one hand tied behind their back through a combination of a lot of regulatory.
This part right here is very important, and it's a huge part of what makes SoFi so undervalued, in my opinion. I got in around $18 per share. So I see this going 5x, 10x in the next 5 to 10 years, at least, at the very least, right? We've seen what happened with Square and how they just monopolized that space. And I think that SoFi, with their banking and lending services, can do the same. But then, of course, you add in the bank charter where they become a bank. And then they also have Galileo, which we'll get into later. So pay attention to this. This is very important.
Regulatory oversight and technology that is in some cases 50 and 60 and 70 years old. They have to compete against SoFi's modern product experience that was built in the last 5, 6, and 7 years. What that's resulted is the ability for SoFi to build this incredibly elusive combination of a best-in-class consumer business and a best-in-class enterprise business. So the consumer business, to start with, looks in the following way. What they have done over the last 18 months is systematically launch many successful products on top of this first hero product, which was the student loan refinance business. And in so doing, what they've been able to do is show 6 quarters of sequential quarter-over-quarter growth. This is the most obvious and important demonstration of product quality, which is consumer adoption. By the end of 2021, we forecast that SoFi will have more than 3 million members. And along the way, with those millions of members, what they are finding is this virtuous cycle in their ability to cross-sell and upsell these new products at low or no cost of acquisition. So what does that mean? When you look at home loans, for example, when they created that product, they were able to upsell that to existing members. And what they found out was 2/3 of the new home loan sales came from existing members. Again, you can imagine that comes at zero cost. In fact, if you look across the platform broadly now, what we see is that SoFi is an incredibly unique situation where almost 1 in 4 of all new product sales come from existing members. In fact, in 2021, there'll be more than 4 million products sold to their members. So now you can see what is building here. Millions.
So this should not be understated. He's going to talk about this a little bit more, but this is the biggest part of SoFi. They get free marketing. They have a super low customer acquisition cost, which means that the lifetime value of their customers increases because they bring in customers into one unit of their business, and then they upsell them, right? They cross-sell them to another segment of the business, and those customers stay around for a longer time, paying more money in their various services between their banking, right? Their banking services, their personal loans, home loans, business loans, and so many other segments in this field. And then they also provide them even more innovative products, like we just saw this week with their IPO, the pre-IPO offering, where customers can now invest in pre-IPO shares at the IPO price, which has never been done before. And that's huge. So this is what this virtuous cycle is, right? This is the flywheel. You bring them in, you serve their needs, and then you continue to serve their needs, and you give them more products to use, and then they become very loyal to you, and they continue to stay and buy more of your products, and then and then they tell their friends about it, and their friends come, and the cycle continues, and you offer more services. And with all of that, you get so much data that no one can compete with you. JP Morgan doesn't have this data, right? JP Morgan Chase, they don't have this data. No one else has the kind of data that SoFi has, and so they can provide even better services to their customers. And that's what he's going to talk about more here. So listen closely. This is very important stuff.
Millions of members at the top of the funnel, consuming millions of products, starts to create what we think is the real competitive moat for this business. Because when you have these millions of people giving SoFi their personal, financial, and behavioral data, what it allows SoFi to do is to build better risk models. And why that's so important is that then it allows them to better price risk. That's how you lend money without losing money in fintech. And in doing that, what they're able to do is take all of those profits and take that success and that confidence and reinvest it into creating more and more products for consumers to use. What that means is that it allows them to then go and acquire even more new customers. And when all of these millions of members are inside of the SoFi ecosystem, they can grow in a cheaper and more profitable way because they can increase the amount of cross-selling. They can do that at lower cost of acquisition, and all of that results in a stickier platform. In fact, when we measured the churn on SoFi, it's multiples better than any other fintech we met. But again, that's just
churn is how much people leave your product after they come in. So if you have 100 people who join your service in the start of the month and then 10 of them leave, you have a 10% churn rate, right? You want to stay below 20% in SaaS companies, in these software companies. So SoFi, what he's saying there is that SoFi has unmatched churn. They don't churn their customers as much as other fintech offerings, right? And that's because they have it's a one-stop shop. When I go into to start saving money with a high yield interest rates from them, I then see they have investments that you can invest like you do on Robinhood through SoFi. Then I see, oh, they have personal loans, so I stay for that. And oh, then they have home loans, and they know all of my information, so they can say, hey, we see you have all this money. Why don't you take out a loan to buy a house, right? And they know they know who you are, and they know where you are in your financial journey, so they can say, oh, you're 2025, you have this much saved, you just graduated college. Why don't you buy a house? Or why don't you start a business, right? And we see where you're spending your money, so we know all this information about you, so we can offer you better services at the right time. And that all of that leads to them having a stickier product that satisfies customers more than anyone else can, and it gives them even more data than everyone else can acquire, which means that they can then take all that data, learn from their information that they've acquired, and offer even better services in the future and at better rates for their customers, right? Which then leads to even more net promoter score, a better promoter score, NPS, and that then goes around, and their customers tell their friends about it. When I first joined SoFi in 2019, I couldn't stop telling my friends about it. You can ask anyone that I knew in 2019. I told them about SoFi, right? I told all of my friends, to my girlfriend about it, and because that's how it goes, because it's such a great product, right? And that's really the value here, just that stickiness. So let's keep listening to him, and that's just half or even a third of the business. Let's listen to the second part of this, which is the infrastructure play, which it's hugely undervalued how big this is going to be, and we're going to talk about that in a second. But this is AWS, right? Amazon Web Services, which is a huge part of Amazon, and this is what he's talking about, because Amazon makes lots of money from their e-commerce site, right? But they make even more. They just print money with this AWS infrastructure unit in their business, where other companies like Netflix and Facebook and Google, they all not Google, but other companies use Amazon Web Services to run their business. They rely on Amazon Web Services to run their business, so Amazon can acquire even more data and produce even more products for those businesses to use. And this is what SoFi is also doing, and this is what he's about to talk about right now. So let's listen in.
One half of the value proposition. All of that is about a best-in-class consumer experience. But what SoFi has done is that they've taken all of that capability, and through a combination of M&A and internal development, exposed all of this so that other partners can build their companies on top of SoFi's infrastructure. Again, this is the AWS of fintech. In fact, great businesses like Chime, Robinhood, Revolut, Remitly, and many others are built on top of SoFi's platform.
And did you hear that? He said Robinhood, Chime, Revolut, and so many other fintech companies are built on top of SoFi's Galileo, right? And I showed you what Galileo is earlier, and they just acquired Galileo, I believe it was last year. And it was a very smart acquisition because not only did they serve the consumers, you and I, but now they're serving the businesses that also serve us, the consumer. So even if you're not using SoFi, you're using SoFi, right? No matter what, no matter where you go, you're one out of every 10 online bank that was created last year was created using SoFi, right? Galileo, because they're infrastructure play. So that's very big. Let's keep listening.
And so what that's created is a really massive tailwind, where as those companies win, so too does SoFi. In fact, SoFi is responsible today for more than 90% of all the new account creation amongst all the neobanks.
Oh, I had that backwards. 1 in 10. 9 out of 10, right? Out of every new neobank bank account created last year, 9 of them out of every 10 was made on the back of SoFi's Galileo, right? They are truly the AWS of fintech, right? At least by these numbers. We still have to learn more about this service, but these numbers show that they are dominating this space. Even Robinhood uses this. Robinhood, the biggest online brokerage out there, right? So this is, you cannot understate this. It's not even priced in at this point. I don't think anyone's looking at this in a way that they're pricing it into the share price right now. AWS was misunderstood in the start. No one knew what it could become until they showed, hey, everyone's paying us $1 million a month, $10 million a month just to use this thing, right? They're making, let's look at this even closer. Look at this. In 2013, AWS, Amazon Web Services, their B2B, business to business unit, made $3 billion. In 2014, they made 4. In 2016, they made 12, 3 times more than they made in 2014. In 2017, they made 17, 2018, $25 billion, 2019, $35 billion, and they made $45 billion in 2020. Galileo can have a similar growth rate as AWS for SoFi, right? And we're going to see that coming forward in the next 5 years. Let's keep listening to what Chamath has to say here. This is a big deal
in the United States. And so when you put these two things together, we think that we are witnessing the beginning of an incredibly powerful financial story. In 2021, SoFi will do almost $1 billion of revenue across these 3 complementary business lines. In consumer, you have this lending business as well as broad financial services. And then on the enterprise side, you have this AWS of fintech, where you're generating revenue from other companies. By 2025, this business collectively will do almost $3.7 billion of revenue. That's a 5-year compounding of 43% a year. At the same time, we're merging with SoFi at this point of profitability. In 2021, they will do $27 million of EBITDA, and by 2025, that will grow to almost $1.2 billion. What that represents is an EBITDA margin of almost 33%.
And that's very good. So they're saying here that last year, SoFi was unprofitable, adjusted EBITDA in that measure. But by 2021, they're going to reach adjusted EBITDA profitability, and which is the standard in these new age tech companies, and by which most of them have not actually met. Most of these companies that you're seeing going public through a SPAC are not going to be adjusted EBITDA profitable for 5, 6, maybe even 7 years in the future. But SoFi plans to be adjusted EBITDA profitable by this year, end of this year. and they're going to be 33% profit margins by 2025. 33%. That's very good. So let's keep listening.
And then finally, with respect to the valuation of the transaction, we priced this deal at an enterprise value of $6.6 billion and a post-money value of $8.7 billion. How did we get to the $6.6 billion? We got there through a sum of the parts. And again, we would separate SoFi into these two really complementary and unique business lines that reinforce each other. On the left-hand side, you have the consumer business, again, comprised of lending and financial services. And on the right-hand side, you have this AWS of Fintech, this enterprise business that we call Galileo. Together, what it creates is a very diversified revenue stream that we think looks really similar to the Amazon growth characteristic, the ability to grow from both consumer adoption as well as enterprise adoption. And we believe it gives SoFi the possibility of compounding very predictably at double-digit rates for many, many years. In terms of a valuation multiple perspective, we also think the deal is priced with a great margin of safety, both for the existing investor base as well as for new investors. $8.7 billion of post-transaction equity value represents a 20 times 2023 PE multiple or a 9 times 2025 PE multiple. To put this in context, when you look at companies like JP Morgan, Bank of America, Goldman Sachs, those are businesses that today trade on an average of an 11 times PE, except those businesses grow on a 5-year basis around 3%. And again, we priced this deal at 9 times for a business that's growing at 43%, so more than 15 times better. And then lastly, just
I'm so sorry, guys. You couldn't hear me. I missed the chat. So let me say that again. What he was saying here. Let's go back. That's awful. Sorry about that. What he was saying here. Thanks for the live chats. I appreciate you. But what he was saying is that if you look at Goldman Sachs, if you look at JP Morgan Chase, if you look at Bank of America, there are all these banks out there that are trading at 11 times their forward 5 years revenues, right? PE ratios. And they are growing at 3% compounded annual growth rates. 3%. And compare that to the 43% that SoFi is growing at. And this deal is pricing, if you got in at $10 per share on IPOE, where they started, where this deal was made at, $10 per share, you're getting in at 9x, right? Versus 11x for the JP Morgan Chase, the Goldman Sachs, and SoFi is going at 43% compounded annual growth rates compared to 3% for those other banks, right? Those other financial services. So he's just saying here that this deal is there's lots of, margin for safety here. There's a lot of upside here in this deal. And what I was trying to say when I was muted is that SoFi that's just the financial services side of things, right? For me, I'm comparing that to the Goldman Sachs and the JP Morgan Chases. That's the 9x for me. But then you look at the Galileo side of things, the infrastructure play, right? Where Galileo is the AWS for the fintech industry. AWS makes $45 billion for Amazon. They just print money with AWS because all these big companies use it. Netflix uses it. I believe Time Warner uses it, right? AT&T, I believe they use it. So all these big companies are using it. Even while the company I used to work at, Medium, they used it, and they're paying lots and lots of money. I can't say how much, of course, but they're paying lots and lots of money to Amazon just to run their business, right? AWS. So Galileo is going to be the same. That's why you see Robinhood using Galileo, which is owned by SoFi. You see Chime, which is one of, I believe, the biggest fintech service out there for what they do. They're using Galileo by SoFi, right? Revolut, they're using Galileo. So we're going to see, and Chamath said, 9 out of every 10 online bank account made last year was made through Galileo, which is owned by SoFi. That's amazing, right? That's just I don't know what else to say about that. That's a big deal. So if they can continue to grow, they will continue to be even more valuable, right? And I will give them a 10x, maybe even 15 or 21x their forward revenues just for that business unit. And if they can make $1 billion in 2025, and I want to give them, and they're growing at like 50%, 40%, that's very fast growth. So I will give them that 15x, right? That 15x the forward revenues, which means that business is worth what, $15 billion, $25 billion on its own, right? And today we're trading around, what are we trading at? About $15 billion in this deal. So, or maybe a little less. So Galileo on its own can more than double or triple what we're currently buying SoFi at, IPOE at, right? So thank you guys for the live chat, letting me know that you couldn't hear me. I muted myself so you wouldn't hear me drinking, but yeah, that's what I was saying. I said it better than the second time. So thank you again. Let's keep listening to what I have to say here.
A 9 times 2025 PE multiple. To put this in context, when you look at companies like JP Morgan, Bank of America, Goldman Sachs, those are businesses that today trade on an average of an 11 times PE. Except those businesses grow.
Yes, I hear you. I hear what you're saying, but I'm valuing Galileo much more than what they have projected here, right? I think what they're doing here is based on the current valuation of Galileo. And I'm saying, from what I've seen from AWS as an engineer, how easy it is for people to ramp up to it. Engineers love it. I believe Galileo can become just as valuable to the fintech industry as AWS is to the larger markets, right? So I still think they are undervaluing Galileo, the rest of the market, not just these guys, but they're basing, they can't say, oh, we're gonna value Galileo at these based on exactly what AWS is doing. And I'm saying, hey, I think Galileo can do similar growth as AWS. So that's just my opinion. You don't have to agree with it. Chamath doesn't have to agree with it, but that's why we're all making our own decisions. And based on what I've seen as an engineer, we love it. We love AWS, and I believe Galileo can continue to grow and acquire even more customers. And they're already doing now 9 out of every 10 bank account, right? So there's only upside here. Of course, they can decrease in the bank account creation and go to maybe 5 out of every 10. But there's even more to Galileo than just the bank creation side of things. So let's keep listening. Good point. But I'm sticking by what I said.
On a 5-year basis, around 3%. And again, we priced this deal at 9 times for a business that's growing at 43%, so more than 15 times better. And then lastly, just to talk about the construction of the transaction. In this merger, there'll be $805 million coming over from the trust account of IPOE. We've also secured $370 million from T. Rowe Price. And then we've done a $1.225 billion PIPE that includes $275 million from myself and my partners personally. This is the single largest investment we've ever made. And so we're extremely excited. We expect the deal to close in Q1 of 21, at which point we think that we're going to see the beginning of an incredibly profound growth story and the disruption of fintech. I'd like to now introduce the CEO of SoFi, Anthony Noto, to walk through the company in more detail.
Before we get to that, let's just take a quick break and let you know if you enjoyed the video, don't forget to like it below, subscribe to the channel, hit the notification bell, and let me know what your thoughts are on SoFi IPOE. And let me say again, like this video. If you don't, then I will take that as meaning that you guys don't like these kind of videos, and I won't do them as much. But besides that, if you want to support the channel financially and keep this channel going, I want to say thanks to my patrons who continue to support the channel and keep it going. So if you want to become a patron, join us over at patreon.boacademy.org. That's where we share our thoughts in a Discord and discuss the stocks and SPACs that we're all invested in real time every day on the stock market. And we get in early on new deals because we share news, rumors, and our own perspectives on these upcoming deals, so that we can all do our own research and come back and collaborate and get in before everyone else has a chance to. That's why we got in early on CCIV Lucid Motors before they ran up to $65. We got in at $12. IPOE and so many others, and SBE, and you know the rest. But anyway, join us over at patreon.boacademy.org. I would love to see you over there. There's about 100 of us now. So anyway, let's keep moving. And I have more thoughts, but I want to get to live chats before we get to what Anthony Noto, the CEO, has to say about this. Anthony Noto, of course, he's a very, very credible guy. I like his story. So let's see some live chats. We have from earlier, we have Brian Gibson saying SoFi is a great company. Been a SoFi member since 2016. Oh wow, 3 years before I was a member, and that's great, Brian. And we have DM saying, when's a solid price to add more on this position? So in the Discord chat, when there was it 2 weeks ago or last week, when it was down to like $13 per share, even $15, $16 per share, we were buying it up, right? I'm buying all the dips. I'm buying it at 15, I'm buying it at 13, I'm buying it at 14, I'm buying it at 17, 18, right? So anywhere in that range, I'm buying it. So that's what I would say to that. Of course, you gotta make your own choice, but I think that we have a lot of upside left to go in this company. Of course, we practice the bull mentality here. And the bull mentality, if you don't know what it is, that's why we got the sweatshirt. So the bull mentality is that we know what we invest in, we understand what we invest in, we believe in what we invest in, and we hold for the long term, because that's how we build wealth in this country. That's how we give ourselves the best chance of success on the stock market. So we're not trying to get in for the next 3 months or the next year. We're trying to get in for the next 5, 10, 20 years, right? So if I'm looking at this as a long-term investment, this is going to be very cheap, right? If you look at Amazon's growth over the last few years, over the last decade or so, we can see that Amazon was misunderstood for a very long time, right? No one understood. Of course, they were very young here, so this doesn't really matter. But even here, 2000, this was the Facebook era, when Facebook was getting started. People still didn't understand the future value of Amazon, right? So then at some point here, 2008, which I believe it matches up with, okay, so 2013 is when they started the AWS web services. So here, people started to get an idea of what Amazon can become. And even more so here, but this is still far below what we have today. And then 2013 comes and we see with the AWS, gets a little bump here. and then AWS 2015. I believe that's when 2015 it jumps by almost double. And then we have 2018, and we can see 2018 AWS went to $25 billion, right? So there's a lot of value here that I believe is just not being priced into Galileo on its own. And then of course we have the bank charter, which is not complete yet. They just bought a bank. So there's a lot of great catalysts to come, right? Of course there's risk. I don't want to just make it seem like there's not risk, but there's lots of competition in this field. But I believe that SoFi leads the field, right? I believe that SoFi is a leader. We can just the stats alone can tell you that much, so I don't have to expound too much on that. So that's why I'm just buying whatever I can with SoFi. I'm trying to get it to 10,000 shares within the next few years, and if I can do that, I'll be very happy. So let's keep reading a few more chats and see what you all have to say. So Brian says they have a great rate match program. That's right. They match the rates of other lenders. This is what has allowed me to consider staying with them as interest rates have gone down over the years. Yeah, when I got in, I think it was at 2.25% on the bank yields. But of course it's down to where everyone else is now. So they try to stay up to the market. And they want to serve their customers, they want to serve their members and help them get their money right. So let's keep reading. I want to just say thank you to everyone who quickly let me know that excuse me, that I was muted. So Brian, Ayaz, Larry, Glenn, Robert, I appreciate you all for letting me know. And John did the face palm. So thank you all for that. I would have just kept going without you letting me know. So I just said, yeah, you have to repeat what you said. Yep, that's correct. And Robert was laughing. So let's see what and he also said that that's what he said earlier about the projections in Galileo. And Robert said he agrees with what I said about Galileo. And Ayes says, do you think SoFi can exceed Square in market cap by mid-decade? I don't know about mid-decade, but Square has been around for a while. So let's see, Square stock. Excuse me. I'm being hit by these allergies very hard. So Square 2015, it's been 6 years now. So they're here. I don't think they're going to exceed Square for a while because Square also just became a bank. They just got their bank charter. And they are doing phenomenal things here and overseas, right? They have Jack's going overseas to develop more of their financial services over there in Africa. So I think Square is a very good business. I don't know if SoFi can compete with their market cap for some time, but I do think that SoFi will eventually catch up. Maybe within the decade, not mid-decade, but within the decade. So that's what I'm banking on. So yeah, I think Square is a good comparison for SoFi. If you want to match them, then great. Let's see. Ayaz also says, how would you rank Stripe, SoFi, PayPal, and Square in terms of investments? Stripe is very special. Stripe is an incredible company. When they go public, I'm buying that. So I'm definitely buying that. I will personally say SoFi, Stripe, and then PayPal, and then Square, because Square doesn't have the developer side of things, the B2B with the infrastructure for other businesses that PayPal, Stripe, and SoFi have. I haven't heard of any like payment processing services or what's it called? SDKs and platforms that Square really has going and people love, but PayPal has Braintree and their own PayPal services that developers like myself use to build payment services for our own platforms. Like I said yesterday, I have my own platforms that I use. Braintree by PayPal. I use Braintree by PayPal to process payments for this platform, and I also use Cloudflare, which is why this site is so fast. And then Stripe, I also use Stripe to pay out my affiliates on my other platforms. So I have an affiliate system that I built on this platform that people can become affiliates of and promote the platform for me. And I use Stripe to pay them, right? I haven't heard too much about what Square offers in this realm of things, and that's what really sets PayPal, SoFi, and Stripe apart from Square, in my opinion. So that's the answer, Ayez. I hope that is helpful. And Leslie B says, I love the channel, Lincoln. Thank you, Leslie. I appreciate it. And Glenn gives a thumbs up. So thank you all for being engaged. Let's get back to some more thoughts on SoFi. Stripe is I just said Stripe is valued at $95 billion, which is exactly what Square is valued at. Square is valued at $97 billion right now. So yeah, exactly. Square, I don't think Square is a match for Stripe. Stripe is extremely special. It's an extremely special company. So I don't know which one, right? SoFi or Stripe. I think they both have great value ahead of them. But I think that SoFi, the reason I take SoFi over Stripe is because SoFi has both B2C, right, business to consumer, which is their user facing services, like their personal loans, their investment app, and all that good stuff, right, where they make a lot of their money. But then they also have Galileo. Stripe is only Galileo, right? That's pretty much it. So Stripe is competing with Galileo in a sense. So SoFi has both. That's why I take SoFi over Stripe. But we'll see. And yeah, Stripe. I love Stripe, but they also have the hype, right? They also have a lot of the hype behind them because their founders are young and they've built incredible products and all of that. But I think that SoFi has a lot more upside given what they've done on the consumer side too, and where they have to go, how much room they have to grow in that space. So that's my thoughts on Stripe versus SoFi. Let's keep listening to this stream. We're going to listen now to the CEO, Anthony Noto. He joined in 2020, in March of 2020, 2020, and he's a inspiring leader. So let's listen in.
Thank you, Chamath. I want to start by talking about SoFi's mission. Our mission is to help our members, that we call high earners not well served, achieve financial independence to realize their ambitions, which means they reach the point that they have enough money to do what they want. I wrote this mission out during the CEO selection process in December 2017. It's why I wanted to be the CEO of SoFi. My inspiration for this mission came from a video of a man expressing his gratitude for SoFi, in which he said something along the following lines. SoFi gave me and my wife the confidence that we had the financial independence to have children. That statement surprised me for a couple of reasons. Something a lot of people do not know about me is that my mom and dad got divorced when I was 3. My mom hadn't graduated from high school, and she had to raise me and my 2 brothers alone for a while. We were on welfare and food stamps, and we were free lunch kids up until middle school. We struggled financially to have what we wanted, similar to the SoFi member in the video. But if you had asked me at any point in time from when I was young until I saw this video what financial independence meant, I would have said it meant being rich. But here was this gentleman equating it to having enough money to have children. The other surprise in the video was that this man was a doctor and his wife was a lawyer. I was surprised to see that people who had achieved so much academically and so much professionally were feeling the same angst that my mom and we felt as we struggled financially. After doing more research, it became clear that many people, including some of my closest family members, were making $100,000.
Before we continue with this, let's watch the video he's referring to. I believe this is the one he's referring to. So let's watch this real quick and so we can have some context.
If your money is working toward the same goals, why keep it in different places? SoFi is a one-stop shop for your finances, designed to work better together. Spend with SoFi and get cashback rewards that automatically go toward your goals, like investing in stocks, ETFs, and crypto. That's better together. Or pay down your SoFi debt sooner. That's better together. And that's how SoFi is helping millions get their money right.
That wasn't quite it. I want to find that video. 1 second. Let's look for that video.
SoFi now offers eligible members the opportunity.
It's all right. I'll find out later, but let's keep listening to what he has to say.
$1,000 in annual household income, above average, and they had very good credit, but they're struggling to live the American dream. This group has been left behind as large banks have walked away from building lifetime relationships with them, because they started to optimize their products and services, or lack thereof, based on ROE. This was a huge opportunity to go out and help these high achievers that were not well served. Every day since I've joined SoFi, I see the impact we have in so many people's lives, and my passion for what we do has increased every day. And this is why I SoFi and why I want SoFi to be my life's work. In order for us to achieve our mission, we have to help people get their money right. This is our unique value proposition. This is the job our members hire us to do. We can't help them get their money right if we only help them borrow. We have to help them borrow better, save better, spend better, invest better, and protect better. So we need to have a comprehensive suite of products and services so that we're there for every major financial decision in their lives. We can't just pick and choose the products we offer based on ROE of the business. We have to pick based on what's necessary to build trust and reliability to help them get to the point they have enough money to do what they want. I knew we were on the right track when I asked the president of one of our partner banks why they weren't in the mortgage business. And this person said to me, "Anthony, you can't make money in mortgage." His answer made me smile inside. How could a company build a relationship with a member and not be there for one of the most important decisions in an individual's life? Buying a home is not only a large economic decision, it's also a hugely emotional decision, so it was never a question of whether we would be in mortgage. It was only a question of how we would reimagine doing it. In fact, we are reimagining all the product experiences and have created a business model that benefits from a powerful flywheel that I'm going to talk about in more detail throughout the presentation. In order to build the best of breed digital native products that are reimagined, we focus on 4 big differentiators: fast, selection, content, and convenience. Everything we do must reinforce one or more of these differentiators. Let me cover them one at a time. No one wants to wait in a teller line to deposit money, and they don't want to wait in an ATM line to take out money. Similarly, in the digital experience, they don't want to wait 7 days after opening an invest account until their money's transferred and they've cleared all their background checks to be able to invest. They don't want to wait 3 days after uploading a check mobilely to their phone to get access to that money. And they certainly don't want to wait 17 days to apply for a loan and wait to get approved and funded. Everything we do has to shorten the distance between when someone wants to do something to when they can do it. This is a digital product. Nothing has to be manufactured or delivered. There needs to be no human contact. We want to shorten the time period to 0. Of course, we must comply with all the regulatory requirements, all the security and fraud protections to make sure your money's safe. But we work every day to be the fastest at whatever you want to do. Second is selection. We obviously have a point of difference because we are a one-stop shop. We have a comprehensive suite of products that covers borrow, save, spend, invest, and protect. But we go beyond that, and we differentiate vertically across each one of those elements. There's an infinite permutation of the opportunity to innovate on selection. Again, this is a 100% digital product. The only limitations to the iterations that we can do on product is our imagination. We use data and learning to iterate and learn, which ultimately leads to innovation. I want to talk about one process we went through to architect our invest product to show you this as an example. We looked across the landscape of offerings as it related to brokerage or invest products. It was clear to me that no one place was offering all the asset classes that are of interest of our members, who we also surveyed. And so we launched SoFi Invest with the ability to buy single stocks without commissions, ETFs of our own brand to help with diversification and better access because they had no loads. We also had lower price points of those ETFs. We also launched robo-advisor accounts and cryptocurrency on one platform. Still today, we're the only company that's offering all 4 of those asset classes and their self-branded ETFs. Since we've launched, we've then added fractional shares, which we pioneered, recurring investments, and we're on our way to introduce portfolios for those that you're following socially on our platform. We will continuously iterate over and over and learn to drive innovation. The third differentiator is content. We provide expert content from popular brands and well-known third parties, as well as educational content. We hold member events on thematic topics such as how to get a raise, buy a house, crypto 101. The content is personalized and delivered right to your SoFi member home feed. We also provide access to free certified financial planners right from your phone. And the last differentiator is convenience. My best example of inconvenience and old mentality is on a Friday after 5 p.m. on a holiday weekend, You try to clear your credit card because it's full and you need to use it over the holiday weekend. But no, you can't clear it after 5 o'clock on Friday. You have to wait till Tuesday morning at 9 a.m. because that's when the bank opens. That's inconvenient. There's no excuse for that in the digital world. We don't have to wait till banks open at 9 a.m. on Tuesday morning, and we certainly can do things after 5 p.m. We will make the experience convenient in a new digital world. These are the 4 differentiators that we put into every one of our products with a continued focus on iteration and improvement that leads to innovation. And we want to do that in a member-centric way. So I've covered our...
So that's a big point, right? He says, hey, we're focusing on these 4
with
points.
A continued focus on iteration and improvement.
We want to be fast. We want to be selective. We want to have a great selection. We want to have educational content, and we want to be convenient. We want to always be there for you. So as a member, I've experienced all of this, right? I just recently got a personal loan in a single day, right? That's great. They also have some of the best interest rates, online yields. Of course, right now it's not great because of the Federal Reserve's reserve rate. And they also have a wide selection. We've seen on their site, they have all of these different offerings from invest to money to credit cards. They have, I believe, the best credit card out there for people who actually care about being financially responsible. Student loan refinance and all this other good stuff and home loans. And then they have the data on all of this from their customers to continue to innovate on all of this, right? So they learn as they go. If something's not working out right, or if people want better services, they can learn from the data that they acquire from all of these services. And from, of course, Galileo, right? If you're using Chime or Robinhood, they get our data from that too. And they can offer their customers more services, better services, based on everything, all that they learn from all these different services that they have out there and from Galileo. So they, as a member, I can attest to all of this. And of course, you can go do your own research and look on the Apple Play Store and on Google Play Store, or the App Store and on Google Play Store to see what the ratings are and what people are saying. And then you can make your own choice on whether or not you believe what they're saying here. So let's keep listening.
That leads to innovation. And we want to do that in a member-centric way. So I've covered our mission, our value proposition, and our 4 differentiators. The last pillar that builds the foundation of SoFi is how to build a competitive, sustainable advantage. Our strategy, the Financial Services Productivity Loop, is about building competitive, sustainable advantage. The 2 gold standards that I've seen over 25 years of following consumer, media, and technology companies are Walmart and Amazon. They have both become low-cost operators because of the ecosystem they've built and the scale they've achieved. They reinvest their lower costs and better margins and lower prices for consumers, better selection, better service, and it drives their flywheel. SoFi is taking a similar yet different approach, which is driving a competitive advantage economically on a per account or per loan basis, and then on a per member basis. In order to do that, we need our products to be best in class against the 4 differentiators I mentioned. So when a member uses one of our products, we build trust and reliability with them such that when they think about a second product, we have a higher odds of success of them choosing SoFi again and again. There are 2 benefits when our members buy the second product. First, we generate more revenue per member, improving our unit economics per person. Second, we don't pay a second customer acquisition cost, which results in lower cost, more variable profit, which we can reinvest back in better prices, better interest rates, better selection, faster service, more rewards, more content, more convenience, and that drives what we call the Financial Services Productivity Loop. In addition to cross-buying benefits, the FSPL is also about driving operating and technology efficiencies to deliver even better unit economics on a per account or per loan basis, rather than being dependent solely on scale. One of the biggest benefits that we've had in our lending business is that we've vertically integrated it across the technology stack, risk, and operations. As a result of vertical integration, we have very attractive per loan economics. In fact, they're better than what I've seen in any direct-to-consumer technology company. We wanted to replicate the same benefits in our financial service products, such as SoFi Money and SoFi Credit Card, which is why we acquired Galileo, among many other reasons. The addition of Galileo's technology platform allows us to vertically integrate our financial services, like we do in loans across our technology stack, risk and operations, that we can achieve superior unit economics in these products as well. We believe our vertical integration of tech and operations via our lending stack, and now the Galileo technology platform, coupled with the revenue and marketing efficiencies of cross-buying, will drive attractive unit economics that will be hard to beat. Now, let's take a step back and think about the opportunity that sits in front of us. Unlike many industries where the winner takes most has already been decided, the opportunity remains for the winner take most in the financial technology and financial services sector. We believe the next decade will be a golden era for digital financial services, where 3 to 5 fintech companies will emerge as leaders, and one will emerge as a winner takes most, and we believe that will be SoFi. There are 500 million U.S. accounts still attached to legacy FDIC incumbent.
Before we go on, let me just clarify what he's saying there. He's saying that just like we see with Tesla in the EV field, the EV industry, there will be many competitors, right? But over time, they will be shaken out, right? It'll be shaken out. Is that a word? Anyway, the competition will narrow. There will be maybe 5 or 10 great EV car companies, but then there will be 1 or 2 that take the most of the industry, that take the biggest market share. So he's saying here that yes, there are currently a lot of competition in this field, but over time there will be about 5 of them that emerge as the best, and of those 5, there will be 1 that takes the majority of the market share. And he believes that's going to be SoFi. And I also agree that it's going to be SoFi. That's why I'm investing in it. But even if it's not SoFi, many of the companies that are in this field rely on SoFi's Galileo to run their business, right? So even if SoFi is not the market leader in the next decade, they will have a huge part in whoever it is in that top 5 or even the top 10 or top 20. Right, so that's all he's saying here, and let's continue with the market opportunity here.
Banks, 500 million, and 50% of them are with the top U.S. banks, top 10 U.S. banks. So they're easy to identify in terms of the competitive offering, and we believe that we are and that we will continue to create a more differentiated product given our modern technology, our lower cost, our better unit economics, and our unique FSPL strategy. The other 50% is pretty fragmented. These financial services companies will struggle to invest enough in technology because of their lower scale. We can help them create a better product and service through Galileo, our technology platform, as well as through SoFi products to better serve their members. So it's a two-pronged opportunity for us, given the fact that so many of these accounts are still tied to legacy old technology incumbent banks that don't have the type of tech or services that SoFi has, and as well as our ability to serve those regional, local banks that communities still want to have as a trusted partner.
So he's saying here, this is big. He's saying here that there's 500 million accounts, bank accounts out there in the United States. And 50% of those of consumer banks are held by the top 10 legacy bank services out there. And those are legacy banks. Right, he's saying that those legacy banks are too far behind to serve their customers well enough, and they're going to be looking for a better solution in the future. And we've seen that. When I got out of college, I was on a legacy bank, and then I left them for SoFi. Right? I moved all my money from them and moved to SoFi because it's so much better. And that's what he's saying here. People are looking for better solutions from those legacy banks, and that's half of the market is in those legacy banks, and they're looking for better ways. And then he has the proof. 50% of Americans use more than one bank for financial services. So that's me. I had a legacy bank, and I still have them. I have some money still trickling into that because I have accounts everywhere. But then I have most of my money in SoFi, and I have a lot of my money in other banks such as M1 Finance and Robinhood. Right? Maybe not a lot, but I have some. And I also have a Chase bank account because they're catching up. Right? They're doing better on the online services as well. And then I also have US Bank because of other reasons, but many people have multiple bank accounts, well, 50% of people, and he believes that they can get those people, those consumers, to switch over to SoFi. That's the opportunity because they're going to offer all these different services. If you're not using SoFi as a bank yet, they're going to offer you a home loan or a personal loan or a business loan, right? Or refinance your student loans. And then you're going to discover SoFi and you're going to say, oh, you guys have high interest savings accounts and checking accounts. oh, I'm going to switch my money to you over my legacy bank account that only gives me 0.01% in interest, and you guys give me 1%, great, right? And so now I'm in SoFi. I have a bank account. I have my student loans, and then I discovered, oh, I want a house. Oh, you also do mortgages, great. You do business loans, great. And now I'm in this system. Oh, and you're not investing. We discovered that you have all this money sitting around in your checking account. You should invest some of that. Oh, we have SoFi Invest. Try that. Oh, you need a credit card? You don't have great credit? Let's help you figure that out. We have content to help you understand the credit system. We have a credit card that will decrease in cost, right? The interest rate on those credit cards decrease. And SoFi is the only one I've heard that does this. If you pay your credit card bills on time for 12 months, it will decrease your APR, the interest rate that you have to pay, by 1%, right? Just to help you get your money right. And that creates more loyalty. And so they tell their friends about it. And their friends come in and they do the same thing over and over again. And they get free marketing, and their customer acquisition cost goes down, and their lifetime value goes up, right? So they make even more money. And then more people learn about online banks as a whole. So if they don't like SoFi, they can go to Chime, they can go to Robinhood, they can go to whoever they want, but they also use SoFi's Galileo, right? So if they don't like SoFi's consumer side, they're gonna go to somebody else's consumer side. They're gonna go to Chime, and Chime's gonna be better service for them. But then Chime's using Galileo by SoFi, and so is Robinhood, right? So SoFi still wins. That's the value. Let's keep listening.
It's also interesting to see how many banks people are using. To create 500 million accounts, it turns out that 50% of people have more than one bank, which signals an opportunity for a better solution, our SoFi solution. The more interesting question, though, is why. 80% of consumers cite the reason for having more than one bank is a lack of an adequate one-stop shop provider. Therefore, these people have to supplement with additional banks. That's a huge opportunity for SoFi, given our strategy, our product offering, and our job to be done. Today, to the best of our knowledge, SoFi is the only company providing a comprehensive set of products in the financial services sector in one app. Many companies have talked about it and prognosticated about it, but only SoFi has done it. It's been an all-out sprint to get to this point of having a comprehensive suite of products in one app.
So there, he's just knowing again that, hey, everyone wants to tell you that they're a one-stop shop, but they're not. They're not doing it. Robinhood's not doing it. M1 Finance not doing it. Even Chime and Dave and all those people aren't doing it. Only SoFi is doing it. We give you everything you need for your financial service life cycle. We give you a bank. We give you credit cards. We give you investment brokerage. We give you personal loans, student loans, and home mortgages, and so many other services that you need. We cover the entire suite that you need to get your money right. So let's keep listening.
And we had to get here as fast as possible, because just being in lending would not be sufficient to deliver on the promise of helping people get their money right. To make it all happen, we've had to build a world-class leadership team that could drive the execution. One of the things I am most proud of building at SoFi is this great collection of executives from some of the world's most successful and well-known tech and financial companies.
Look at this. So we always talk about how important management is.
One of the things I am most proud of building at SoFi.
These people all come from great consumer companies, and SoFi is a consumer company first, right? So he started at Twitter. I believe he was a CFO, and then he went to the and then he became, I believe, the COO, and then he went to the NFL, and then he was also at Goldman Sachs. So he's been in both consumer and banking, right? And he's been their CFO was the CFO of Uber, and he was at Goldman Sachs. She's been at TPG and another bank service, Goldman Sachs. Amazon, she's been at Amazon for what's it called, consumer side of things, and now she's here with Money, Invest, and credit cards. So this team is great, and the content and insights. This lady Jennifer has been as Zynga, which is a gaming service company, and she's leading content and insights, right? And then, of course, this is the Galileo CEO, founder and CEO, and he's been at Galileo, right? So he's going to continue leading that. And then they also have a senior management team that's also well qualified in both consumer and banking, right? Financial services. So let's keep going.
Is this great collection of executives for some of the world's most successful and well-known tech and financial companies. I want to spend a second and share with you our journey. In the first quarter of 2019, we were on our way. We launched SoFi Money, SoFi Relay, and SoFi Invest. And after reformulating our end-to-end approach for home loans, we relaunched the mortgage business in the first quarter of 2019 as well. In the third quarter of 2020, we introduced our credit card as well as our innovative rewards platform. And in the third quarter of 2019, we introduced in-school loans, which is an important touch point to reach our members before they make the first big financial decision in their life. We are now definitively in every one of the 5 categories that I mentioned. In addition, we've built these service offerings on one common mobile platform. We've also built an important social area of the application, which we call the member home feed. Think of the SoFi member home feed the same way you would think about the home feed within Twitter, where people go to see what's happening in the world, or Facebook's home feed, where people go to see what's happening with their friends, or the LinkedIn member home feed to see what's happening in business. In the SoFi member home feed, we show members what's happening in their financial lives. In addition to injecting all the different forms of content in a personalized way that I mentioned earlier into a member's home feed, we're using data from all of our members' product usage and the rest of our ecosystem to deliver personalized cards in their feed that answer 3 questions for them every day. What must you do in your financial life today? What should you do? And what can you do? There are an endless opportunities to build frequent engagement in our member home feed, and it's a big driver of our new product adoption. The member home feed has on average driven 15 to 25% of new products over the course of 2020. The member home feed is an important part of our strategy and our ability to use data as a competitive advantage to further drive our financial services productivity loop advantage. So what has all of this produced in terms of results? Well, our member growth is accelerating and the financial services productivity loop is working. We are on track to exceed 3 million members and the growth of 75% in 2021, with an anticipated lifetime value that continues to increase. We've seen 6 consecutive quarters of accelerating year-over-year growth in members on the back of the first half of 2019 product launches. Impressively, not only did we drive 4 quarters of accelerating growth, but now having anniversary of the first 2 quarters, we've been able to build on that growth rate and looking at 75% year-over-year growth in 2021 to 3 million members. Q3 2019 was the first quarter of an acceleration in member growth to 37%, and that has accelerated every quarter since to 75%, estimated in the fourth quarter of 2020. Now,
this is the growth rate, right? This is what you want to see. This is a fast-growing company. So a valuation of 9x for a 40% CAGR, growing at 75% this year and last year, I think that's undervalued. So, yeah, they can hopefully reach this 3 million membership goal projection by this year. If they can do that, then that gives us all as investors more confidence in the team to actually set big goals and actually reach them.
Not only are we seeing strong growth rates in the number of members, but we've seen strong growth in the multi-product member base as well, which is more than doubling in Q4 2020, and we're forecasting an increase of 94% year over year on our way to nearly 1 million by the end of 2021. As I mentioned, our competitive sustainable advantage is being achieved through the FSPL. Again, we want to build trust and reliability in one product that will lead to success in the next product, thereby driving more revenue per user at a lower cost, giving us the highest LTV and the highest variable profit per member. Let's look at this example. In the center of this page is the unit economics for personal loans. In personal loans, we generate about $2,000 of adjusted net revenue per loan. We have operation costs of about $300 and a customer acquisition cost of about $825. That results in approximately $940 of variable profit per loan, which is an unmatched level of variable profit on a direct-to-consumer business that I've seen in my career. On the left-hand side of the page, we show the unit economics from a money member. Notably, the money member's customer acquisition cost is $40, meaningfully less than the $825 for the personal loan. The productivity unfolds when we acquire the money member, first for just $40, and we build trust and reliability with that member. And then when they need a personal loan, they choose SoFi. When that happens, we do not pay the $825 in customer acquisition cost on the average personal loan. And instead, we increase our variable profit to approximately $1,700 per member from $940 on a standalone basis. We can reinvest that additional variable profit in better interest rates, better selection, faster service, more rewards, more content, and more convenience.
So what he's saying here is, this is a big deal. What he's saying here is that it costs them to acquire a personal loan. So without being a SoFi member, if they want to get a personal loan customer, this is what it costs them right here. So it costs them $825 to acquire a user, personal loan customer who is not already a SoFi member. And then it costs them, they get variable profits of $938. And their profit margin here is 45%, right? So they get $1,000. But then with the cross-selling impact, they get a variable profit of $1,763, right? But over here, it doesn't cost them with the membership. If you're a member of SoFi already, it only costs them $40 to acquire that member. So down here, they get even more money from you if you're a SoFi member, because they don't pay this $825 in acquisition cost. They already got you here at $40 to get you into the SoFi ecosystem, and then once they get you, they can sell you on this personal loan, and they make this variable profit of $1,763 versus the $938, which comes out to a total of $1,000 over here. But if you're already a member, this comes out to $1,848 in variable profits, which is an 80% profit margin, which is about 100% more than what they would get from you if you were not already a member of the service. So that's very good.
Driving the key variables that differentiate our product versus others and drive our sustainable competitive advantage through the FSPO. So that's a look at a per member economic scenario when cross-buying from money to personal loans. But what happens when 50 or 60% of our personal loan products are bought by an existing member versus 22% today? What happens when the majority of the variable profit per loan is at $1,700 instead of a standalone basis at $940? Well, we don't have to ask what happens when it comes to home loans because we know. In fact, 65% of home loan originations come from existing members. That high percentage of cross-buy resulted in home loan revenue of $30 million in the third quarter of 2020 on just $1 million in marketing. This is the financial services productivity loop at its best. In personal loans, 22% of our loans are taken by existing members and about 20% for student loans.
So he's saying here, take the math we just did over here for personal loans.
22% today, $140.
Sorry, take this math that we just did, the difference between this 44% and this 80%, and this 806 or is $825 and $40 per acquisition cost. Take that. This is 22%, right? This is 22%. Over here with the home loans,
22% today.
It's 65%. 65% of home loans that they sell comes from existing members. That's versus the 22% for personal loans. So it's even better for home loans, which are bigger, right? Home loans are bigger than personal loans because homes are more expensive than what you're gonna get for a personal loan, because they're only gonna get anywhere between, I don't know, $10,000 and $50,000 for a personal loan. But to buy a house, you need a lot more money than that. So they're gonna get a lot more return on their investment in this home loans. So if they can get 40% more of their customers from home loans than they get from personal loans, that's better for the company, right? So this is the value of this entire financial services product suite. Once you're in there, they have you. They can offer you more services. And then they get free marketing. They get to upsell. They get to cross-sell you their other products, including home loans. So that's the value here. I hope I explained that math correctly back in the last slide. But It's a little complicated, but the basics is that it costs them less to acquire customers for their personal loans, and it costs them less to acquire customers for their home loans. But they get even more of the customers from for home loans than they get, or from existing members than they get for personal loans, right? So it's all just free marketing for them in this sense.
What happens when the majority of the variable profit per loan is at $1,700 instead of a standalone basis at $940? Well, we don't have to ask what happens when it comes to home loans because we know. In fact, 65% of home loan originations come from existing members. That high percentage of cross-buy resulted in home loan revenue of $30 million in the third quarter of 2020 on just $1 million in marketing. This is the financial services productivity loop at its best. In personal loans, 22% of our loans are taken by existing members and about 28% for student loans. When these numbers get to 50 to 60%, the P&L of those products will benefit in the significant way that we're already seeing in home loans.
So he's just saying there exactly what I just said, that home loans are already at 65% of their originations coming from existing members. Personal loans are at 22%, and student loans are at 28% of originations coming from existing members. And he's saying what happens when they come up to the same rate as home loans are at 65%, or just 40% or 50%, right? Then they start to make a lot more sense for the business. They become a lot more profitable for the business because you drive down expenses, you drive down marketing cost, customer acquisition cost, and that means that your return on value increases. That's very simple math, right? So if they can get those personal loans and student loans to come to the same rate of acquisition as home loans, then a lot more money is going to be printed.
And this page shows you exactly what the economics are across all of the home loans in third quarter on a per loan basis. In the quarter, we generated $10,000 in variable profit per loan across all loans, not just those that were cross-bought, with $5,000 of incremental variable profit coming from the lower acquisition cost due to cross-buy. Looking more broadly, we've seen very good trends for cross-buying, even though it's only been 5 quarters since launching the broader suite of products. On the left-hand side of this page, we show for student loan refinancing, the percentage of loans that were bought by existing members in the fourth quarter of 2019. The first bar on the far left shows that 8% of student loans were bought by existing members. The percentage increased sequentially every quarter since to estimated 20% in the fourth quarter of 2020. The same trend appears for personal loans, going from 6% in the fourth quarter of 2019, estimated to be at 22% in the fourth quarter of 2020. For home loans, as I mentioned, we've been above an average of 65%, the gold standard. In the 5 quarters since launching in-school loans, we've been a big beneficiary of cross-buying for this product as well. Invest has also been a very strong cross-buying product, as you can see on the chart, with quarters in which we've had more than 40% of the new Invest accounts coming from cross-buying. Money is a key feeder product at the top of our funnel, and we're focused on making sure it's growing as fast as possible to help drive the rest of the funnel, the widest at the top, driving down to the bottom. These percentages on the prior page are important, but absolute numbers are very important as well. And in Q3 2020, while we were seeing good cross-buy rates into loans, the top of the funnel, i.e. the high frequency and low CAC products, are still relatively small compared to the absolute size of the bottom of the funnel. But by the end of 2021, the scale at the top of the funnel becomes almost 2x the bottom of the funnel. So with the same cross-buying rates, we should see an acceleration on the impact of personal loans and student loans from cross-buying from other products. As other products become much bigger, we will likely end 2020 at about 30,000 cross-bought loans and expect that to double to 60,000 in 2021. 60,000 cross-bought loans has a potential of generating an incremental $50 million of variable profit that we can reinvest across our products in better prices, better interest rates, better selection, faster service, and all the key differentiators we are investing in to build our competitive advantage. It'll also allow us to feed the top of the funnel to drive an accelerating growth in those high-frequency, low-CAC products. What you see on this slide is our full-stack technology, risk, and operations in loans. Our full-stack in lending has helped achieve superior unit economics per loans, and it's also allowed us to launch new products quickly, with 5 new products launched in just 12 months at a lower cost if we had built from scratch. Having a full stack also provides 4 key ongoing benefits. 1, it supports faster innovation. 2, it drives lower costs at scale. 3, higher velocity of iterative testing. And 4, more actionable data. These capabilities and benefits are what we wanted to replicate in our financial services products, SoFi Money, SoFi Credit Card, and other future products, which is one of many reasons why we acquired Galileo.
So he's just saying there that because they have this vertically integrated service stack, they can produce services faster than anybody else can, right? Faster than they would have been able to without it, right? So Galileo has a value to SoFi itself, just being able to build fast, right? Iterate on products, learn quickly from the data that they're acquiring, and then build new products that help their customers a lot more.
Galileo is a tech platform that absolutely accelerates the financial services productivity loop. It will allow us to innovate faster on SoFi Money to drive more direct deposit accounts, which feeds the top of the product funnel. It also lowers our costs and improves our unit economics for SoFi Money by about 20% that can be reinvested in a more attractive offering. Additionally, SoFi can offer its loans, its brokerage service, and the Lantern Marketplace to 50 million Galileo customers that it connects through its partners, increasing the value that Galileo provides to its partners. In addition to that, SoFi is building out unique technologies like dynamic fraud capabilities and other features we know the whole industry uses and will need, and we can offer these technologies and products to Galileo's partners to reach their 50 million users. This is one example of our vision to build out the AWS of FinTech. We couldn't be more.
So he's saying here that besides offering those other customers of Galileo services, they can use those customers' own clients, own customers, right? So they can use Chime's customers or Robinhood's customers to offer those people their SoFi services, loans, personal loans, and home loans and student loans through SoFi and through Galileo. So they benefit twice. And then they also provide that same value to their Galileo customers, clients. So not only do they give you the technology, they give you the rights to say, hey, we have a simple partnership with SoFi that you can get a home loan through SoFi or a personal loan through SoFi, right? So there's value on both sides of this relationship between SoFi and Galileo's customers.
More excited about the acquisition and how it makes SoFi better, and equally how it makes Galileo better. But even more importantly, Galileo was already a great business as a pioneer in building a transactions platform and bank-in-a-box technology services. The company has a very high market share of new bank accounts on its platform across the most well-known digital-first fintech consumer companies. Between growth in existing partner accounts and growth in new partners, total account growth has accelerated year over year for 7 consecutive quarters, reaching 50 million accounts in the third quarter of 2020, with a growth rate of 131% year over year. In addition to being very fast-growing, diversified revenue stream, the business also has very high margins and high ROE. In closing, we couldn't be more excited about the market opportunity in front of us, our strategy to capture it, and to stay ahead of everyone else and be the winner that takes most.
Let's do that for a second. Let me just show you this again because I was zooming out. So here he's showing that Galileo is growing at 131% year over year from this year, right, in customer acquisition. So this is very promising because let's look at Amazon, AWS, right? This is Amazon AWS's growth rate in revenues. So Galileo is growing pretty similarly. They're starting to ramp up their growth rate in total accounts that are going through Galileo. And if we want Galileo to become the AWS of the fintech industry, then we're going to have to see similar growth in Galileo as Amazon has in AWS. And he also says that Galileo has high margins in their business because again they're a SaaS company. They build once and then they keep charging you their own recurring revenues, right? And their Galileo customers pay them or sign up for multi-year contracts. So all they have to do is get the customer in, and then continue to service them, but also keep taking in those recurring revenues. And their expenses are front loaded. Once they build a product, those expenses are already been accounted for. Now all they gotta do is acquire revenues and maintain the service, right? So let's keep listening to what it has to say here.
Being very fast-growing, diversified revenue stream, the business also has very high margins and high ROE. In closing, we couldn't be more excited about the market opportunity in front of us, our strategy to capture it, and to stay ahead of everyone else and be the winner that takes most. These are the underlying core platforms that we're leveraging to do it, and it's going to be incredibly hard for others to replicate it at the scale that we've already achieved. With that, I'd like to turn it over to our Chief Financial Officer, Chris Lapointe.
And to end that, he says, hey, we know there's lots of competition in this space, but look at how far we've come. Look at how much we've built, and look how fast we're moving, right? And we have Galileo on our side, right? No one else can move as fast as us. It's going to be it's going to be very hard for them to replicate what we've done already and then catch us. So even if the next guy comes today comes today and tries to compete, they have to do everything that we already did, and they have to do it faster so they can catch up. And it's going to be very hard for them. It's going to be very hard for them to do it faster because we have Galileo on our side. Of course, they can go try to build Galileo as well and do everything that Galileo does, but then they have to build Galileo and do that as well, and also build the consumer side and build the B2B side, the business to business side, right? They have to build both Galileo and build SoFi. So how are you going to catch up to SoFi? It's pretty hard, right? Of course, it's not impossible, but it's going to be very hard. So that's a margin of safety.
Great. Thanks, Anthony. So I'm going to start by walking through the progress we've made since 2018 and where the business is heading. I'll then dive a little bit.
Before we get to the financials from the CFO, let me just take a little break and remind you all that if you're enjoying the stream, don't forget to like the video below, subscribe to the channel, hit the notification bell, and comment your thoughts on SoFi. And of course, leave your comments in the live chat. I'm going to get to those in a second. And I have live chats from our patrons that I'm also going to read. So I love for you guys to continue to engage. I appreciate it. And let me know what you think about Galileo and SoFi and the math that we looked at with the personal loans and home loans and all that growth rate. And yeah, there's just a lot to cover here. So let me read some live chats real quick. And Mason in our Patreon Discord says he just opened up a account plus credit card with SoFi, and he was surprised after opening up a credit card that they gave him 2,000 points worth $20 to save, invest, or pay down debts. He definitely this is definitely something that makes the customer feel appreciated. So yes, I agree fully. The credit card, I have it. I'm using it right now. It's only criticism I have is that they don't currently have a way to increase your credit limit. So right now there's only $9,000 on my credit card. I would like to double that, but it's all right. They just started that credit card, so hopefully in a few months they'll actually give you a way to increase your credit limit for people who can afford that. And excuse me. So that's all the live chats for now. But if you have any thoughts, let me know. And if you want to support the channel financially and join us over at patreon.bullacademy.org, you can join our Discord channel where we discuss the stock market in real time every day. And of course, I provide my early research into new companies I'm becoming bullish on, and we discuss, we share research and we share news and rumors and other great deals so that we can get in early before everyone else has a chance to, like we did with CCIV, SPE, IPOE, and so many other deals that has come up in the past. So I would love to have you over there. It's about 100 of us now. And if you're interested, join us over at patreon.bullacademy.org. And now let's jump into the final part of this webcast.
A little bit deeper into our segments and how each will evolve in the coming years. And then I'll wrap it up with some insight into the benefits of a bank charter and its potential impact on our long-term earnings profile. Our summary financials show the great progress we've made over the last few years, and most importantly, how we've successfully navigated through a period of significant uncertainty and macro volatility. In 2018, we delivered $241 million of adjusted net revenue and lost $227 million of adjusted EBITDA. In 2020, we expect to deliver north of $620 million of revenue and lose $66 million of adjusted EBITDA. And that's on the heels of a strong Q3, where we delivered more than $200 million of adjusted net revenue and positive adjusted EBITDA. This marked improvement was driven by our lending segment, where we had strong sales execution and relaunched our high-margin home loans business. We also acquired Galileo in May of 2020, which contributed approximately 50% of the year-over-year improvement in both the top and bottom line. Looking forward, we expect top-line growth to accelerate to 58% in 2021 as we look to deliver $980 million of adjusted net revenue and achieve full-year adjusted EBITDA profitability. We'll continue to invest in the business to drive growth, and by 2025, we expect to be a $3.7 billion revenue business, delivering over $1 billion of adjusted EBITDA. To help explain how we intend to deliver on our forecast.
So he's talking here about the revenue and adjusted EBITDA profitability growth rate that they expect to have over the coming, 5 years. And we start off here in 2018, where they're making $241 million in net revenues. And they almost doubled that in 2019. And in 2020, they are at $621 million. And then in 2021, they're expecting to get to nearly $1 billion in net revenues. So $980 million. So that's a pretty big growth, 58%, right? They're growing by 58% this year. At least that's the projection, right? We're yet to see if they can actually meet that, but that's what they expect to do in 2021. So I have pretty good confidence that they can actually do that because of what we've seen over the last year. And this year, people are getting more interested in building wealth, right? Understanding their financial situation and bettering that. So I think they can meet this, and we'll see as the quarters come in Q1 and Q2 of 2021. We can see if they're actually getting close to that, if they're on track. And then in 2022, they expect to make about 53% in growth of that, and continue with 40%, 33%, and 31% growth until they get to $3.6 billion or $3.7 billion in net revenues by 2025. And along with that, we have to do the adjusted EBITDA, which is the profitability measure. And in 2018, they lost $27 million in EBITDA. They lost 149 in 2019. They lost $66 million in 2020, which is a good growth rate of 49%, less losses, right? And then 2021, they expect to become adjusted EBITDA profitable with $27 million in adjusted EBITDA revenues. Excuse me. And in 2022, they expect to get to $254 million in adjusted EBITDA profits. That's a huge jump. That's almost 10x in a single year. So that means that they expect to cut down their expenses by a lot, or they expect to grow the revenue by what we see here, right, about $500 million. So if they can both reach this revenue goal at the same time as cutting down on their expenses, they can actually reach this. That's a pretty aggressive goal. We'll see if they can actually reach that next year, but that's pretty aggressive. I don't know if that's going to be possible, but we'll see. So then there's a lot more conservative, where they are doing 38% the next year, and then again 43% in 2024, and to end the projections, they get to 2025 with 45% growth, which they will be at $1 billion in adjusted EBITDA profits. So that's very good. And what is that? About a 30% profitability margins. So these are pretty aggressive goals, and of course the projections. So we'll see if they can actually meet this year's and the next year's, and then we can make up our minds on whether or not we believe in this company going forward. So we have to continue to check in and make sure that they're actually reaching their goals that they're setting. So again, I think it's aggressive, but hopefully they can meet it, and I think that they have a good team to do that. They've been at high growth companies like Twitter and at Amazon and so forth, right? So they know how this goes. They've been there. So now they have to replicate the same amount of growth here at SoFi.
To help explain how we intend to deliver on our forecast, I'll walk you through how we think about and manage our business. Overall, we look at our business across 3 segments. First is lending, which includes student loan refinancing, personal loans, home loans, and in-school loans. Second is our technology platform, which includes Galileo and our 17% ownership in Apex Clearing. And then third is financial services, which includes Money, Invest, Credit Card, Lantern, Protect, and Relay. Quickly touching on the various business models and key revenue sources. Our lending segment is primarily a gain on sale model, whereby we originate loans and recognize a gain when we sell them via our whole loan or securitization channels. We also generate net interest income by holding the loans on the balance sheet for a period of time prior to sale. Within the tech platform segment, we generate revenue primarily through Galileo, where we receive fees from customers using their online bank accounts, swiping cards, making deposits and withdrawals. This is a nice recurring revenue stream, as the vast majority of Galileo customers have multi-year contracts. And finally, we're just starting to monetize on the various businesses within our financial services segment, and those revenue streams are dependent on the business, but primarily driven by member assets on the platform and engagement. One of our objectives is to have a mix of businesses at various stages in their life cycle, with varying revenue growth and profitability profiles, such that we have long-term compounded annual revenue growth of 25 to 30%. We target modest margin growth balanced with appropriate investment, such that we don't underinvest and fall short of our long-term potential. And you can see our strategy starting to take shape, as we have a nice mix of growth and profitability across segments. Our largest and most established lending segment delivered 58% contribution margins in Q3 2020, with expected annual revenue growth of 25% over the next 5 years. Our tech platform segment is delivering 62% contribution margins, with forecasted annual revenue growth of 55% over the next 5 years, as the business is well positioned for the secular growth of online mobile banking. These two segments collectively help fund the growth of our more nascent financial services segment, which will start to reach real revenue scales over the next 12 to 24 months.
These are very good margins. 58%, 62%. That's very good. Where of course they're looking at 33%, I believe, profit margins in 2025. But these contribution margins, which is profits after fixed costs are accounted for, is very good. These are not trivial numbers to reach. So they're doing pretty good on these lending and tech services that they offer.
This page also addresses another crucial benefit of our diversified portfolio, particularly as it relates to interest rates. One of our key achievements over the last 2.5 years was successfully navigating different interest rate environments and developing the muscle to do so going forward. Our businesses uniquely benefit from both high and low interest rate environments. With high rates, our personal loans business does better with incremental demand, and our money product also does better as deposits grow significantly with yields. On the flip side, with low rates, both our home loans and student loan refinancing businesses do better, along with Invest as people seek to enhance yields.
So what he was explaining there is just trying to speak to all the fear around rising interest rates, right? Or low interest rates. So he's saying that regardless of where we are in interest rates, whether they're high or they're low, we're going to win, right? In high interest rates, we do well with the money accounts, because people want to deposit more money into their bank account so that they can get higher yields, right? 1%, 2%. And in low interest rates, we do better because people are taking out more loans. So we then get more profits from those products, personal loans, home loans, and so forth. So they're saying, hey, we don't care what the economic policy is at any moment, because we're going to win on both sides. And before we continue, let me just read. I missed one live chat from earlier. So let me just read that real quick. Ayaz asked, Lincoln, one risk I see with SoFi is if education becomes free in the USA and student loan is no longer required. That's a big revenue stream for SoFi, but they are vertically integrated, so thankfully. So yes, there is a risk that student loans go the way of dinosaurs for the most part, but I don't agree with that, because I don't think that, well, today you don't need to take out huge student loans because there are community colleges. You can go to a community college, right? So people can afford to go to that for the most part and do it and work on the side to pay for those smaller costs to go to community colleges. So if we get to a point where community colleges are completely free, then yeah, people are going to take out less student loans to pay for public colleges, because you don't have to anymore. You just get to go to public colleges for free. So that's great. I actually want that life. I want that society where we educate our people. But there always will be people who want to get the higher prestigious education from the Harvards, from the private schools out there. And there's many private schools that will very gladly take your money to give you that prestige, right? So people will always want that. And so there will always be people who want to pay for, who want to take out student loans to get that higher, that brand name education. So I'm not too concerned about that. And student loans is not as big as we learned as home loans, right? Or personal loans for SoFi. So they have enough loan products out there and lending products out there to do just fine if student loans become inadequate, or what's it called, antiquated by public schools becoming free, right? So I'm not too concerned about that, but yeah, it is a risk that we will lose some profits on that business, or some revenues on that business. And Jube responded to Ayaz saying, I don't think education will be free. Biden already said that he is against forgiving student loans. It's a business. So yeah, the politicians do not want to make education free. I don't know why it's good for the country, but whatever. So let's keep listening before we cover more live chats. We're almost done. Only 5 minutes left. I know it's been a long one, but we're almost there. Thanks everyone for staying in there. I know it's a long one. Don't forget to like the video below, subscribe to the channel with the notification bell, and join us over at patreon.boacademy.org. So let's finish this video.
Our diversification is only going to continue to improve. In 2020, 83% of revenue will come from our lending segment, 17% from our tech platform segment, and the remaining 2% from financial services. As we continue to invest in our tech platform and financial services segments, we expect our revenue mix will be more evenly split in the long term. And by 2025, lending will comprise 43% of revenue, financial services 32%, and our tech platform 25%. So here's a look at our segment level forecast for the next 5 years.
So they're expecting by 2025,
tech platform segment.
By 2025, they're expecting that Galileo and their tech offerings will account for 25% of the revenues. That's $1 billion, pretty much $900 million, right? And then their financial services, which is so far, what's it called, invest and money, will account for 32%. And then their lending will account for 43%. This will be the biggest. The home loans, the personal loans, the student loans will account for 43% of their business. So this is what their goal is by 2025. And Galileo is a huge part of that, right? If Galileo can reach $1 billion business on its own, that's going to be very profitable for the company because they have the highest margin. Galileo has the highest margin. So the bigger Galileo grows, the better it is for SoFi, because that means that their Galileo customers are doing well. And SoFi, and there's going to be more customers coming into Galileo, which means more revenues at a higher margin, profit margin, which continues a virtuous cycle of Galileo becoming the AWS of Fintech. And remember, AWS is a very profitable business for Amazon. This is how they've been growing over the last 7 years. Look at this, from $3 billion to $45 billion. So if Galileo can go from $200 million to $1 billion for SoFi in the next 5 years, and then to $10 billion from there, that just goes to show how valuable this business can be. But then I also forgot to mention that they are a 1/6 holder of Apex Clearing. And Apex Clearing, according to Fast Company, is 2021 most innovative companies, right? They were awarded one of the top 10 most innovative finance companies of 2021. And SoFi, through Galileo, owns 1/6 of this company. And Apex Clearing, I believe, is going public through a SPAC. So they're just acquiring fintech infrastructure companies left and right, right? They own 1/6 of this company. They own Galileo. So SoFi is saying, hey, if you don't like us on the consumer side, you don't have a choice. You're going to have to use us one way or another. You're going to have to be a SoFi customer one way or another, right? So if you don't like SoFi's offerings, but you like Chime, but you like Robinhood, you like Revolut, you can use them, but you're still paying us at the end of the day, right? That's the value of Galileo. and I believe is super undervalued. I don't think people are realizing how valuable this is going to be for SoFi. So Apex Clearing is one of the clearing houses out there for brokerages, and yeah, it's going public. So that's another public company that SoFi is going to hold a big chunk of. Let me read a few more live chats and then we can finish this. We're almost there. And don't forget to like the video. If you don't like it, then I don't know that you enjoy the video and I won't do it. So please do like and subscribe. So let's read a few more comments. Ivan Rojas says, who's SoFi's big competition in fintech? Is any other company trying to build something similar? I think M1 Finance is doing something similar, and so is Robinhood, but they're not lenders, right? They don't do personal loans and home loans. They what they have is brokerages. Who else is in this space? They keep reaching out to me. Earnest Money, I believe they're called. They keep sending me these mail things. I forget what the company is called, but it's Earnest something. So there's enough competition here, and I can look into that later and cover that. But there is definitely competition. But SoFi, as far as I can tell, is the best. There's a whole bunch of high yield savings accounts, which is another space in what SoFi covers. But SoFi has the one-stop shop working for them, and they believe that from all of their research, they're the only ones doing what they're doing with covering the entire spectrum of all the services that you need to get your money right. So let's read a few more. Ashron also says Apex Clearing is going public through a SPAC. Yes. Jubei says possibly Square, PayPal, and RKT stock. Who is RKT? Rocket Companies. So yes, Rocket Companies does lending, but they don't have the full suite like SoFi does with the other products that SoFi offers. So yeah, there's customers in every segment. There are competition in every segment that SoFi covers. But again, that's the value of SoFi. I don't want to go to all these different places to get what I need. I'm just gonna go to SoFi and get all of it at once, right? So yes, Ivan. That's pretty much what I'm answering. Who else is building a vertically integrated financial services company? Pretty much what I said. I don't think SoFi is matched in that arena. They are you get everything you need from SoFi, and then there's many other options in each segment that you can go to left and right. So I want to just have it all in one place. And Ashton also asks, is it worth investing in Apex Clearing? I don't know enough about the clearinghouse space, so I can't say too much on that right now, but it's definitely Fast Company, Forbes, and who else? CNBC or CNN and the Wall Street Journal seem to all like them, so you can do your own research on that, but I don't want to mislead you on that space. So let's finish this. We're still at 5 minutes left. Let's finish this.
And the remaining 2% from financial services. As we continue to invest in our tech platform and financial services segments, we expect our revenue mix will be more evenly split in the long term. And by 2025, lending will comprise 43% of revenue, financial services 32%, and our tech platform 25%. So here's a look at our segment level forecast for the next 5 years, where we expect to grow revenue at a 43% compounded annual growth rate and deliver margins of 30% plus. From an adjusted net revenue perspective, our lending segment is expected to grow from $514 million in 2020 to $1.6 billion in 2025. And that growth will be driven by a few factors. First, we will further build on the momentum in home loans, where we grew revenue 6x in 2020 to north of $100 million annually. We will invest and capitalize on current macro trends, and with less than 0.1% market share, we believe there's plenty of headroom. Even at the scale we model in 5 years, we'll capture a modest 1% of the overall market. And we expect this business to drive approximately 50% of overall lending growth over that period. The remaining growth within the lending segment will come from personal loans, where we expect to return to pre-COVID origination levels after intentionally pulling back in 2020, as well as from our student loan refinancing business, where we expect to retain our strong market share. Our tech platform segment is expected to grow 55% annually from $103 million in 2020 to $900 million in 2025. And this growth over the next 12 months will be driven by continued growth of established customers on the platform, as well as an acceleration among customers recently integrated and onboarded in the past several quarters. Beginning in 2022, we will start to see growth from new customers in the pipeline as we expand product offerings and enter new geographies at scale. Switching to financial services, where we expect to grow over 150% annually over the next 5 years, as many of our recently launched businesses start to scale. A meaningful portion will be driven by our invest businesses, both in the US and internationally, as we invest in marketing to scale our member base and roll out new features to further improve monetization. To date, we've been super focused on driving to sustainable unit economics with very limited marketing spend. We're at the point now where we're ready to start investing in growth, and you will see that in our projected top-line account metrics and revenue. We'll also see meaningful growth in our money and recently launched credit card businesses. From a profitability perspective, we expect full-year EBITDA profitability in 2021 and to continue to modestly expand margins throughout the next 5 years until we reach approximately 30%. Margin improvement will be driven by a few factors. First, a mix shift within our lending segment towards home loans. Second, material margin expansion in financial services as we hit an inflection point in money and invest over the next 12 months, where variable profits start to exceed fixed direct costs. And then finally, we expect to see real operational leverage across the entire company. The last thing I'd like to cover is an important element of our longer-term strategy.
So all he said there was that they have a small percentage of the market in personal loans and home loans, and they expect to even if they get that to 1%, that will help them get to their 143% CAGR over the next 5 years. So, and then of course they have their financial services that they plan to grow, and their tech sector they plan to grow. And today they're at 3% adjusted EBITDA profit margins. In the future, by 2025, they expect to get to 32% adjusted EBITDA profit margins. So that's more than 10x the profit margins, right? So today their financial services are unprofitable, right? That's the top of the funnel. They bring in new customers by driving more growth in those money losing services like money and invest, right, and content. But over the years, they plan to make those businesses profitable, and that will help them, which is they're growing at about 153% compounded annual growth rate. So that will eventually become profitable, and all of that will help them get to their 32% profit margins in adjusted EBITDA and about $1 billion in adjusted EBITDA by 2025. So that was just a roundup of how they plan to grow this business to get to profitability. So let's keep listening. We're almost there. 2 minutes left.
Strategy, which is to obtain a national bank charter. Doing so is perspective. We expect full-year EBITDA profitability in 2021 and to continue to modestly expand margins throughout the next 5 years until we reach approximately 30%. And margin improvement will be driven by a few factors. First, a mix shift within leverage across the entire company.
Back.
Last thing.
So now we're going to talk about the bank charter, which we haven't even discussed yet, right? When they become an official bank. So let's listen to what he has to say here.
I'd like to cover is an important element of our longer-term strategy, which is to obtain a national bank charter. Doing so is beneficial in many ways. First, it lowers our overall cost of capital. Currently, we rely on third-party warehouse providers to fund our loan originations, with cost of capital of 200 to 400 basis points, depending on the interest rate environment and warehouse provider.
One second. So what we're looking at here is this dark blue is the current forecast without the bank charter. So this is where we are right now with this dark blue, and this is what they're projecting, and this is what the 2025 projected just adjusted EBITDA revenue will be, profits will be $1.177 billion. So all of these dark blues are without the bank charter, right? We haven't even projected all of that. We haven't even included the benefits of the bank charter yet. So now he's saying, hey, look at what we can do once we have a bank charter officially in our projections. So 2021, they expect to have it approved and they become an actual bank, right? Just like Square just got their approval. Square got the bank charter approval. Now they're saying in 2022, we expect to make almost 40% of our revenues, adjusted EBITDA revenues, from our bank charter. That's not even included in these projections yet, right? Remember that 9% or that 9x that we talked about earlier, and how I said it was undervalued because of Galileo. But then we didn't even discuss the bank charter. So now adding the bank charter, and they're projecting about 40% of the revenues coming from that in 2022. And then, of course, the rest of the business continues to grow even faster than the bank charter will grow. But the bank charter is going to continue to add a steady, $200 to $300 million every year in their revenues, which is just free, which is just there. It's always going to be there, right? It's just going to consistently be a good part of the revenues going forward. So in 2023, $230 million. It becomes a smaller percentage as the company builds the rest of the lending and financial services and Galileo continue to grow. But this is still a huge part of the revenues, right? We're still at about 25% here, and then maybe a fifth, 20% here. So this bank charter, this is 20% upside for you because it's not included in projections yet. So let's keep listening.
With a bank charter, we could use our money deposits to fund originations, thereby significantly reducing our cost of capital. Second, we would reduce the need to turn over our balance sheet as frequently as we do. Currently, we hold loans for 3 months and then sell, essentially turning over our balance sheet 4 times per year. With a bank charter, we would have the flexibility to hold loans for longer than 3 months, resulting in higher net interest income. And finally, we would have the ability to modestly grow our lending business, as we would not be constrained to the same extent as we are today on warehouse capacity. Together, these benefits enhance both durability and profitability. And the chart that you see on this page provides an illustrative view of the earnings impact of the potential reduced cost of capital, an extended hold period from 3 to 6 months, and conservative growth in loan originations. Collectively, these benefits translate to approximately $200 to $300 million of adjusted EBITDA per year and $1 billion cumulatively over the next 5 years. In summary, we're really excited about the opportunity ahead of us and appreciate you all listening in to hear our story.
And that's it. There's no Q&A. So this is this is just promising, very promising, right? SoFi, we saw most of that presentation was around the lending, the financial services, and the tech sectors of their business. But then we get to the end and they say, oh look, we also want to be a bank. We want to be an official bank. And that's going to add about 25 to 20 or 20 to 25% of revenues to our adjusted EBITDA in 2025. They just say that at the end, right? So they already got preliminary approval, and they hope to get that finally approved this year. And they just bought a bank. They just announced that they're buying a bank, right? A physical bank to get that started. Instead of building a bank from scratch, you're going to just build on top of what they're currently buying. So that's not even being valued in or included in this valuation currently, because they haven't projected the revenues for that yet in their actual projections. So I like what I'm seeing here. Of course, I want you to make your own choice. I don't want you to just take my enthusiasm and just go run with it. Right? I'm not a financial advisor. This is not me telling you to buy, sell, or hold any positions. But for me, I'm super excited about this. I like SoFi a whole lot. I want to own a bank, and I want to own a company that serves their customers first, and they serve their customers around the world through their technology offering through other businesses, right? Chime, Robinhood, and Revolut. They all use SoFi's Galileo, right? So that's the value here, and I really like it. And then just to touch on that last part where he was talking about the value of becoming an actual bank versus using other bank partners, is that they get to move faster. They get to offer their customers better rates because they don't have to go through a third party and split revenues with that person, with that third party. They don't have to use another bank. So they can offer their customers better rates. They can offer loans faster, and they get to make the rules, and they get to move as fast as they want. They get to innovate on their speed. It's like Tattoo Chef. Tattoo Chef doesn't have to go through partner producers. They produce all of their products in-house, 90% or so in-house. So they're not limited like other producers are. right? It's the same idea. They get to move at their speed. They get to move at their pace. They get to serve their customers the way they want and innovate at their own discretion. So let me read some live chats. But before we do that, if you enjoyed the video, like it below, subscribe to the channel, hit the notification bell. If you don't like the video, of course, hit the dislike button, but I need you all to let me know whether or not you like it, because if you don't, then I can't continue to produce these videos, because YouTube's gonna say, nope, not showing that to our viewers. So let me know if you like it or not. So let's see some live chats real quick. And if you're a patron, don't forget to comment in the live stream comments so I can make sure I get to you all, because you're the ones who keep the channel running at patreon.boacademy.org. So let's see some live chats here. And then we can call it a day. So let's see. Ivan says, who else is, okay, I already read that part. And Ivan says, how do you think Chamath's investment in this company, involvement in SoFi, impacts the company's growth? Chamath was one of the guys, the main guys at Facebook back in its early days when they were growing at super speeds to get to 2 billion users, right? So Chamath has great experience in growing companies fast and in consumer companies fast. So now that he's at a consumer financial services company that also needs to service his customers, well, Facebook doesn't really service users, but it's different because in SoFi, they are hyper-focused on serving the customer, and their customers are their customers, not users, right? But Chamath knows how to actually get the word out and do the marketing correctly. So he can advise in that sense. So let's see other comments. IS responds to Ivan saying, I think Chamath's recent negative public image would die out. At the end of the day, he's incredibly successful. Regardless, SoFi will not be defined by Chamath. That's correct. SoFi is its own company. Chamath is an investor, and maybe is going to have a board seat through social capital, being an investor in this company. But it's not just Chamath in the company, right? He's not representative of SoFi. But I think the recent what's it called? Drama around Clover Health, which I never thought was a good investment in the first place. I don't know why people were so excited about that, but that drama is gonna die out at some point, and it'll be fine. I like Chamath. So Glenn says, buy the product, not the salesman. So yeah, it's not about Chamath, it's about the product. So focus on that. Focus on the numbers. So Ivan also asks, what department does SoFi need improvement in? They're an amazing company, but where do you guys see some holes, if any? Just curious on your opinion. So I did touch on this a little bit. They do need to make their investment app better. I'm not a huge fan of it. They have to make that more seamless, more delightful, like Robinhood. I much prefer Robinhood over SoFi Invest. But I do use SoFi Invest for my more passive investments. I use Robinhood for my growth investments. So they have a lot of work to do in just the user experience of Invest. But that product is still very useful. They have their own ETFs. So for people who don't want a safe way, to invest, they can use that. And I would prefer if they made their blue. I know it seems like a small thing, but if they made their blue a little bit more vibrant, right? Their color blue, I think that would help just the feel of the app a lot more. This blue seems a little dull to me. So I know it seems small, but people care about that stuff. I build platforms for a living, so it matters. And they can improve also on their, like I said earlier, on their credit card. There's a lot of room left to grow on that. I need them to add a way to increase my credit limit. That's just a personal request. I hope they get that news, that request at some point. And let's move on to IS. IS says, thanks, Lincoln, for doing this. FYI, my price target for SoFi is $75 by 2025. That's a fair price target. I'm looking at more than that, but we'll see. And Ashwin says, do you think SoFi will try to buy out Apex Clearing again? They tried before in the past, but it didn't work out. Well, if they want to, they can keep buying shares and just take it over if they want. But I don't know. I haven't looked into that too much. But if it makes sense, then yeah, they'll find a way to buy them out if they really want it. So Apex Clearing seems like a promising company that, like I said before, Forbes, CNN, Fast Money, all saying it is a fast company, all saying it is a good company. So we can, and SoFi owns about a sixth of this company, and they're going public. So like I said earlier, SoFi is saying, hey, you don't like us, you don't like our consumer app, we're going to be everywhere you are through the background, right? We're going to be in the back end of all your other services. And let's see. Yeah, it says, Lincoln, since you want to own a bank, you should buy out SoFi with your SoFi gains. Co-CEO of Anthony Noto. Yes, I would love to do that one day. I would love to own a bank, be a large minority owner or maybe a majority. But that's a long way to go. But I'm gonna keep buying SoFi for now and just keep building on my shares. And then Ivan says, thanks, brother. So yeah, I appreciate you all for being here and engaging, commenting in the live chat, and letting me know when I messed up with the audio. So I apologize for that again. I wanted to make sure you all didn't hear my drinking, because this is very my mouth gets dry sometimes when I'm doing all of this talking. So anyway, thank you all again for being here. I appreciate you. If you enjoyed it, don't forget to like the video below, because YouTube needs your engagement so that they know that this is a good video and you want me to keep doing this. And don't forget to subscribe, comment, hit the notification bell so you always get our notifications, so that you know when we're doing another live stream or a new video. And if you want to support the channel financially, join us over at patreon.boacademy.org. You'll get more access to me, get direct answers to your investment questions, and you'll be able to engage on our Discord channel where we share knowledge and discuss the stock market and the stocks and SPACs that we're all investing in real time, so that we can all do our own research and share and collaborate and come back and make better investment decisions together. So if you're interested in all of that, then join us over at patreon.boacademy.org. I'm Lincoln with boacademy.org. Thank you again, and have a great day.